Welcome back to The Deep Dive. We're the show that dives headfirst into complex stuff, pulls out the insights you need, and hopefully keeps it interesting along the way.
Absolutely.
Today, we're wading into personal finance territory, specifically a tax that, honestly, a lot of you might not even know affects you.
It flies under the radar sometimes.
It really does. Our mission here is simple. Give you a genuine shortcut to understanding this without you having to wrestle with those, super dense IRS documents yourself.
Yeah, we'll do the wrestling for you.
Exactly. We're unpacking the net investment income tax, the NIIT, and our goal isn't just explaining the basics, like the 3.8% rate. We want to go line by line through the official IRS instructions for Form 8960, really dig into the rules, the nuances.
It's the practical stuff.
Yes. And crucially, zero in on those key strategies for tax savings. Show you exactly where the opportunities are hiding in plain sight.
And that's what I love, digging into those patterns and details that really make a difference.
Perfect. Let's dive in. So first things first. Form 8960. Why does this form even exist? What's its core job on your tax return?
Okay, so Form 8960, it's purely for calculating the net investment income tax. And the absolute first thing to get straight is that this isn't part of your regular income tax calculation.
Right.
It's an additional tax.
Yeah.
Think of it as an extra layer, a 3.8% levy specifically on certain types of investment income.
On top of everything else.
Exactly. On top of your normal income taxes.
Yeah.
And the rules we're talking about today, they come straight from detailed IRS regulations, which, lay out the whole framework.
Okay, additional tax, that's critical. So who actually gets hit with this extra 3.8%? Is it like anyone with a mutual fund?
No, not everyone. And that's a really key point for listeners. For individuals, you only need to file Form 8960 if two things are true.
Yep.
One, your modified adjusted gross income, your MGI is over a certain threshold. And two, you actually have net investment income. You need both. If one isn't true, you're generally off the hook.
Got it. MGI over the limit and NII present. What are those MGI limits for, say, 2024?
Right. For 2024 taxes, those thresholds are pretty clear. If you're married filing jointly or a qualifying surviving spouse, it's $250,000.
Okay, $250K.
If you're married filing separately, it's much lower, $125,000.
Half, right?
Exactly. And if you file as single or head of household, the threshold is $200,000.
$200K.
Now, it's really important to remember, NGI isn't always identical to your regular adjusted gross income, your AGI.
Okay. How's it different?
Well, your AGI can be modified for NIT purposes. The big adjustments usually involve things like excluding foreign earned income, or if you own certain foreign entities like CFCs or PFICs. Those kinds of things can change your NGI calculations specifically for this tax.
So details matter there. What about estates and trusts? Do they pay it too?
Yes, they do. The NIT applies to domestic estates and trusts as well. For them, it kicks in if they have undistributed net investment income and their adjusted gross income, their AGI, is more than the dollar amount where the absolute highest income tax bracket starts for that year.
So it's tied to the top tax bracket, not a fixed number, like for individuals.
Precisely. It targets the higher income estates and trusts.
Okay, so once you're over the threshold and you have NII, how is the actual tax figured out? Is it 3.8% on all your investment income?
Not necessarily. This is another really important point, the smaller of rule. The tax is 3.8% of the smaller of two numbers.
Okay.
Either your total net investment income or the amount by which your NGI or AGI for estates trusts goes over that threshold amount we just talked about.
Ah, I see. So if your NGI is only slightly over the limit, say by $10,000, but you have $50,000 in NII, you only pay the 3.8% on that $10,000.
Exactly right. The tax base is capped. It prevents the tax from applying to more income than the amount that actually pushed you over the threshold. It's a crucial limiting factor.
That makes sense. Now, you mentioned rules and regulations. What's a fundamental piece of advice the IRS gives for dealing with this tax?
Record keeping. It sounds basic, but for NIT, it's absolutely paramount. It's not just a good idea, it's foundational for any kind of tax management or saving strategy here.
Why is it so critical for this specific tax?
Because, you see, certain income and expenses get treated differently for NIT compared to your regular income tax.
Yeah.
They're unique rules, so you absolutely need to keep all your records, all your worksheets, everything related to what you put on Form 8960.
Okay.
And here's the kicker, the longevity. The IRS instructions emphasize keeping records for the entire life of an investment.
Wow. The whole life, not just like 7 years.
The whole life,
Okay.
especially for tracking your basis. This is vital if you have carrybacks or carry forward from prior years, because what happened years ago, your cost basis from way back, directly impacts your current NIIT calculation. And having that proof is essential to support any exclusions or deductions you claim to lower the tax.
That's serious record keeping. Okay, let's get into the nitty-gritty then. What exactly counts as net investment income? This feels like where the real action is for tax saving.
It absolutely is. Understanding this definition is key. So generally, net investment income, or NII, includes the gross income from the usual suspects: interest, dividends, annuities, royalties, and rents.
The common stuff.
The common stuff. However, and here's your first big potential tax-saving insight: these are not included in NII if they come from the ordinary course of an active trade or business.
Active trade or business. Okay.
Meaning, it's a business you're genuinely involved in, not just a passive investment, and not a business that's primarily trading financial instruments or commodities. That distinction is fundamental for NIIT.
So income from my active consulting business, even if it generates interest, might be out.
Potentially, yes. If it's truly derived in the ordinary course of that active business, it's generally excluded. Now, NII does include other gross income from a trade or business that is passive, meaning you don't materially participate,
Right.
or if the business is trading financial instruments or commodities. And finally, NII includes the net gain from selling property. Unless, again, here's the exception: the property was used in an active, non-trading business.
Okay, that active business exception keeps popping up.
Central.
Yeah.
And then to get to net investment income, you take all that gross income and subtract the deductions that are properly related or allocable to it.
Makes sense. So just as important as what's in is what's out. What kind of income is definitely excluded? This seems crucial for planning.
Absolutely critical for tax saving. Understanding the exclusions is job number one. Excluded income covers a few things. First, anything already excluded from your gross income for regular tax, like interest from tax-exempt municipal bonds.
Okay.
Second, income that just doesn't fit the definition of NII anyway. And third, specific income and gains that the NIT law itself explicitly excludes.
Can you give us some common examples of things that are excluded, things people often worry about?
Definitely. And these are big ones for many people. Excluded income includes your regular wages from your job,
Good.
unemployment compensation, Alaska permanent fund dividends,
Okay.
alimony received, Social Security benefits. And this is huge. Most distributions from qualified retirement plans. We're talking your 401k, 403bs, traditional IRAs, Roth IRAs, 457b plans. That income is generally safe from an NIIT.
Wow, so retirement withdrawals are mostly protected? That's a massive relief for retirees.
It is. Also importantly, income that's already subject to self-employment taxes is typically excluded. The idea is to avoid hitting the same income with both SE tax and NIIT.
That double taxation avoidance makes sense. So pulling from my IRA in retirement or getting my paycheck, generally not triggering this extra 3.8% tax, even if my income is high. That's a really practical takeaway.
A very practical and important one. Okay, shall we walk through part one of Form 8960, line by line? This is where you see these rules in action and spot the adjustments.
Let's do it. This is where the planning happens. Start us off with line one.
All right, line one is for interest income. You start by pulling in your taxable interest from your main forms, like
Okay.
Form 1040. Pretty straightforward. But here's a key tax-saving adjustment we touched on. If you have interest income that was earned in the ordinary course of your active business, again, not passive, not trading, that interest is out.
How do you take it out?
If it gets included initially on line 1, use line 7 later on, we'll get there, to make a negative adjustment, essentially backing it out of the calculation.
Got it.
Also, something called self-charged interest. If you get interest income from, say, a partnership or S-corp, where you actively participate, but it's not a trading business, you might be able to adjust that out on line 7 too. Another potential reduction.
Interesting. Okay, what's next? Line two.
Line 2 is ordinary dividends. This is where your regular dividends go, usually from your 1099 DIVs. Again, look for potential tax-saving adjustments. Dividends you receive from employer securities held in an ESOP, an employee stock ownership plan, those are generally out.
Okay.
And Alaska permanent fund dividends, those are also excluded. You'd use line 7 again to make those negative modifications, specific carve-outs.
Good to know. Line three.
Line 3 is annuities. You include gross income from annuities here. But remember those crucial exclusions for annuities that come from qualified retirement plans, 401ks, IRAs, Roths, etc. Those are generally safe.
Right, the retirement income exclusion.
Exactly. Also, amounts paid for services rendered are excluded. A helpful tip: if your Form 1099-R has code D in box 7, that usually flags an annuity amount that is subject to NIIT. It's a hint on the form itself.
Okay, that code is useful. Now, line 4A looks like a big catch-all.
It is. Line 4A is income from trades businesses, rental real estate, royalties, partnerships, S corporations, and trusts. It basically scoops up income from all these sources, often reported on Schedule E, Schedule C, K1s, etc. It's the starting point.
And this leads us to line 4B, which you flagged as really interesting for tax savings. This lets you reduce what's on line 4A. Tell us more. What gets taken out here? This sounds like a major opportunity.
It absolutely is. Line 4B, the adjustment for net income or loss, derived in the ordinary course of a non-Section 1411 trade or business, is critical. This is where you subtract income as a negative number or add back losses as a positive number from activities that are specifically excluded from NIIT.
Okay, break down those exclusions again. They seem vital.
They are. The big one is net income or loss from an active Section 162 trade or business that is not passive and not a trading business.
The core exception.
The core exception. If you materially participate, and it's not trading stocks all day, the income from that business is generally subtracted here if it somehow got included on line 4A. This is huge for active entrepreneurs.
Yeah, it seems massive. What else?
Also, net income or loss from a business, even if passive, or trading if the income is already subject to self-employment tax. Again, avoiding that double hit.
Right.
Royalties derived in the ordinary course of an active, non-passive business are also adjusted out here. And certain passive losses from a former passive activity that are now deductible.
Okay. Now, you mentioned real estate earlier. How does this apply to real estate investors? This seems like a hot area for NIT.
It is. And line 4B is incredibly important here, especially for real estate professionals. This is a specific tax status. If you qualify, your rental income might not be considered passive for NIIT.
How do you qualify? Is it difficult?
It requires significant time commitment. There's a safe harbor rule. You qualify if you participate in each rental real estate activity for more than 500 hours a year.
Wow, 500 hours per activity.
Per activity. Or, alternatively, if you participated in a rental activity for more than 500 hours in any 5 of the last 10 years.
Okay, that's a high bar, but potentially worth it. What's the benefit?
If you meet these tests, your rental income and any gain or loss when you sell the property is treated as derived from an active trade or business.
Meaning?
Meaning it's not included in your net investment income. You'd use line 4B to subtract it out. This could be an enormous tax saving for genuinely active real estate investors. It takes potentially large amounts of rental income completely out of the 3.8% tax calculation.
Huge. What if you don't meet the 500-hour test?
You're not totally out of luck. You can still argue that your rental activity is an active trade or business based on all the facts and circumstances, even without the safe harbor. It's just a higher burden of proof.
Okay. Are there other ways rental income might escape NIIT?
Yes, there are special rules for certain rental income, providing another adjustment possibility. Even if you're not a real estate professional, rental income can sometimes be treated as active business income and thus excluded under 2 scenarios.
What are they?
1, if the rental property is used in another trade or business where you do materially participate, think renting a building to your own active operating company.
Oh.
Or 2, if a rental activity is properly grouped with another active trade or business activity you materially participate in under specific grouping rules.
Grouping. Okay, that sounds technical, but potentially useful.
It is. In these cases, the gross rental income and related gains losses are treated as non-passive active business income. Again, not included in NII. You'd adjust it out on line 4B.
So how you structure things, how much time you spend, whether you group activities, it all dramatically impacts the NIIT treatment of rental income. That really is an aha moment. It's not automatic passive income.
Not at all. The details of your activity matter immensely. Now, moving on to lines 5A through 5B. These deal with gains and losses from selling property. Capital gains territory.
Right. What's line 5A?
Line 5A, net gain or loss from disposition of property, is generally where you report gains from selling assets not used in an active business or property from a business that is subject to NIIT, like a trading business.
Yeah.
Think stock sales, mutual fund sales.
Your typical investment gains.
Exactly. Importantly, it only includes gains actually taxed. So gain excluded from selling your home under Section 121 or gain deferred in a Section 1031 like-kind exchange, those are not included here. They're already excluded from income.
Good. Now, line 5B sounds like another adjustment line. Net gain or loss from disposition of property that isn't subject to NIIT. What gets backed out here?
Precisely. Another powerful adjustment. You use line 5B to exclude gains as negative numbers or add back losses as positive numbers that were on 5A but shouldn't be subject to NITT.
Like what?
The main one, again, is gain or loss from selling property that was held in your active, non-NIT trade or business. Sold a business asset. Gain is likely excluded here.
Okay. The active business theme continues.
It does. Also, gain from net unrealized appreciation, NUA, in employer stock from a retirement plan. That initial NUA portion is excluded when distributed.
Right.
But remember, any appreciation after distribution is subject to NIT when you sell. There are also some complex rules for excluding certain gains from foreign investments, like QEFs, if specific elections are made.
And you mentioned something about capital loss carryforwards earlier.
Yes, a nuance on adjustments to capital loss carryforwards. If, in a prior year, starting from 2014, your excluded capital losses, like from selling active business assets, exceeded your excluded capital gains, you have to adjust your capital loss carryforward specifically for NIT purposes going forward.
What?
To ensure you don't get a double benefit, excluding the loss initially, and then also using it to offset future investment income subject to NIT. It keeps the NIT calculation accurate over time. It impacts future tax savings.
Complex, but makes sense for fairness. What about line 5C? Partnership or S-Corp stock?
Right, line 5C. Adjustment from disposition of partnership interest or S-corporation stock. Generally, selling your interest in a partnership or S-corp does generate NII.
Okay.
However, there's a strategic adjustment available. If you materially participated in an active, non-trading business activity conducted by that partnership or S-corp.
Material participation again.
Yes, then you might be able to calculate an adjustment that reduces the gain or increases the loss for NIT purposes. This results in a negative entry on line 5C, directly lowering your NII.
So your active involvement in the underlying business can shield some of the gain when you sell your ownership stake.
Exactly. It recognizes your active role. You do need to attach a statement explaining the calculation, though.
Okay. And finally, line 6. CFCs and PFICs sounds specialized.
It is. Line 6 is for adjustments to investment income for certain CFCs and PFICs. This is mainly for people with complex foreign investments. Income from controlled foreign corporations and passive foreign investment companies generally is NII, often showing up on other lines.
So what's line 6 for?
It's for additional adjustments, specifically related to the complex anti-deferral rules governing these entities. And critically, it relates to a strategic choice. The regulations, section 1.141110G, election.
An election, what does it do?
If you own stock in a CFC or a QEF, you can make this election. If you do, certain income inclusions are counted as NII currently, but then later distributions of that same income, called previously taxed income, are excluded.
And if you don't make the election?
Different rules apply. You might have to include certain distributions of previously taxed income in NII or use different basis calculations. Making this election is a one-time permanent decision for that specific stock.
Wow, permanent.
Yes. It's a significant tax planning opportunity for those with these types of foreign holdings, letting them choose how that income stream interacts with the NIT over the long term.
Okay, so that covers the income and gain side thoroughly. Now let's shift to deductions and modifications that actively reduce NII. Line 7, other modifications, seems like a key place for this. What are the big tax savers here?
Line 7 is indeed where some major reductions can happen. It catches various items that decrease your NII.
Like what?
One of the most potentially powerful is the net operating loss, NOL deduction, for NIT purposes. If you have a regular NOL from, say, a business loss, a portion of it might be deductible against your net investment income.
How does that work? Is it the full NOL?
Not necessarily. You need to calculate your Section 1411 NOL. It's basically the NOL you would have if you only considered NIT-related income and deductions.
Okay.
You compare that NIIT-only NOL to your regular overall NOL for the year. The amount you can use against NII is the lesser of those two. This applicable portion is what reduces your NII.
Can you give an example?
Sure. Let's use the IRS example. Say someone had a regular NOL of $120,000 in 2022, and the calculated NIT-specific portion of that was $60,000. That means the applicable portion is 50%, $60K, $120K.
Okay.
Now, fast forward to 2024, they use $110,000 of that 2022 NOL carry forward to reduce their regular taxable income. For NIT purposes, they can deduct 50% of that $110,000, which is $55,000, as a negative amount on line 7.
So the applicable percentage applies to the amount used in the current year.
Exactly. It directly reduces the NII subject to the 3.8% tax. One important note, NOLs from before 2013 can't be used against NII because the tax didn't exist back then.
Got it. What else goes on line 7?
Other above-the-line deductions. These are deductions you take on Schedule 1 of your Form 1040, things that reduce your AGI. If any of those are properly allocable to a passive activity or a trading business and weren't already accounted for elsewhere, you can deduct that portion here as a negative amount. Also, that self-charged interest adjustment we mentioned earlier for interest income. If you had passive treatment under those rules, the corresponding negative modification goes here on line 7.
Right. And what about getting money back, like tax refunds, deduction recoveries?
Good question. Generally, if you recover an amount you previously deducted, like getting a state tax refund, that recovery increases your NII in the year you get it back.
Okay, that makes sense.
But there are two key exceptions based on the tax benefit rule. The recovery is not included in NII if the original deduction didn't actually reduce your NIIT liability in the prior year.
So if the deduction didn't save you NIIT, the refund isn't taxed by NIIT.
Correct. And second, the recovery isn't included if the amount you deducted was already included in your NII calculation in that prior year. It prevents a weird double counting.
That seems fair. Avoids hitting you twice if the deduction didn't help with NIIT initially.
Exactly. Now that brings us to Part 2 of Form 8960, which focuses on investment expenses allocable to investment income. These are mostly your itemized deductions related to investments.
Okay. How do you figure out how much of, say, state taxes relates to investment income versus wage income?
That's where reasonable method allocations come in. This is a crucial area offering flexibility for tax savings. If you have a deduction, like state income tax, that applies to both NII and excluded income, like wages, you can use any reasonable method to allocate the portion attributable to NII.
Any reasonable method. What's considered reasonable?
The IRS gives examples. A very common one is allocating based on their ratio of your gross investment income to your total AGI.
Okay.
But other methods might be reasonable depending on your specific facts. This flexibility allows you to tailor the allocation, which is a real tax planning tool, to maximize the deductible portion against NII. This applies to state local foreign income taxes, tax prep fees related to investments, and certain estate trust admin expenses.
That allocation power seems really useful. What are the specific lines in Part 2?
Line 9A is investment interest expense. This is interest you paid on loans used for investment purposes, typically deducted on Schedule A or Form 4952. Line 9B is state, local, and foreign income tax. Here you put the portion of those taxes you allocated to your net investment income using that reasonable method, but only if you didn't claim a foreign tax credit for the foreign taxes.
Right, the allocated amount.
Line 9C is miscellaneous investment expenses. These are expenses directly tied to producing investment income, like investment advisory fees.
Now, there was a big tax law change affecting these miscellaneous deductions recently, right? How does that impact NIT?
Yes, a very significant point for current tax planning. The law change suspended miscellaneous itemized deductions subject to the 2% of AGI floor for regular tax purposes for tax years 2018 through 2025.
So those deductions are gone for regular tax?
For regular tax, yes. However, for NIIT purposes, the instructions clarify that these expenses, if properly allocable to investment income, can still be deducted on Line 9C without being subject to that suspended 2% floor or the overall limitation on itemized deductions, which is also suspended.
Wait, really? So even though you can't deduct them on Schedule A, you can deduct them against NIT?
That appears to be the case, according to the Form 8960 instructions for these years. It means potentially larger deductions against NII than you might expect. It's a temporary but significant tax-saving benefit during this 2018-2025 window. Definitely something to look into.
Wow, that's a huge takeaway for those years. Okay, what's the last line for deductions? Line 10.
Line 10 is additional modifications. It's a catch-all for other allocable deductions not reported elsewhere.
Anything notable here?
Yes, a very special rule for traders. If your only business is trading financial instruments or commodities, you can deduct your trading business expenses from Schedule C directly here on Line 10, even if they didn't reduce your self-employment income.
Ah, specific benefit for full-time traders.
Exactly. It allows them to deduct those business expenses against their investment income for NIIT purposes. If they have other businesses too, there's a worksheet to figure out the allocable amount. It's a targeted tax break.
Okay, we've covered income, exclusions, deductions. Let's wrap up with specific situations. For individuals, besides the MNGI thresholds, any other key points or strategic choices?
Well, we hammered the MNGI thresholds. 250K MFJ, 125K MFS, 200K single hook age, because they're step one.
Right.
For non-residents NRAs, the tax generally doesn't apply. Simple enough.
Okay.
But it gets interesting if you're a U.S. citizen or resident married to an NRA. Your default status for NIIT is married filing separately, below 125K threshold.
Ouch. Is there a way around that?
Yes, a strategic choice. You can elect to file jointly with your NRA spouse for regular tax and specifically elect to have that joint filing apply for NIT too.
What does that do?
If you make that NI2 election, you use your combined income and deductions, and critically, you get the much higher $250,000 married filing jointly threshold.
Yeah, that could make a huge difference. Definitely a strategic decision.
A very strategic decision. Also, for dual resident or dual status individuals, resident part of the year, NIT generally only applies for the resident period. But importantly, the full annual threshold amount still applies. It's not prorated.
Oh, that's helpful.
And bankruptcy estates use the $125,000 married filing separately threshold.
Okay. And finally, for estates and trusts beyond the AGI threshold, how do distributions play into their NIIT calculation? You mentioned this was key for fiduciaries.
Absolutely key. It comes down to line 18B, deductions for distributions of net investment income and charitable deductions. This is where trusts can significantly minimize NIIT.
How?
The trust's undistributed NII is directly reduced by any NII that's included in distributions made to beneficiaries.
So passing the income out reduces the trust's NII.
Exactly. The same applies to NII allocated to deductible charitable contributions made by the trust. So strategic distributions to beneficiaries or charities are a primary way for fiduciaries to lower or even eliminate the trust's NIIT liability. It's a critical tax planning tool for trusts.
Makes sense. Push the income out to where it might be taxed less or not at all. Are any trusts just exempt entirely?
Yes, several types are exempt. Charitable trusts, qualified retirement plan trusts, charitable remainder trusts, grantor trusts, where the grantor pays, electing Alaska Native settlement funds, cemetery trusts, and things not technically trusts for tax purposes like REITs. Knowing these exceptions saves a lot of trouble.
Good list to be aware of. Any other special trust rules?
Just brief mentions for special computational rules for things like qualified funeral trusts, QFTs, and linking small business trusts, ESBTs. They have their own unique ways to calculate NII and AGI, reflecting their specific structures. Highly specialized, but the rules exist.
Okay, wow. We have really gone deep into Form 8960. What stands out most, I think, is that this NI isn't just some minor add-on tax. It's complex.
It really is. It has its own complete set of rules, what's in, what's out, how deductions apply. It demands specific attention.
And our journey today really hammered home that understanding those details, especially identifying income from truly active businesses, like for that qualifying real estate professional, or strategically using NOLs, or correctly allocating expenses with a reasonable method, especially during this 2018-2025 window with the suspended limitations. That's where the real management happens.
Absolutely. Those are concrete ways to potentially lower your liability. Every line, every definition holds potential.
And for people in those complex spots, foreign investments married to an NRA making the right elections is crucial. That Section 1.14110G election or the joint filing choice, those aren't small details.
They are major strategic decisions with potentially large dollar impacts.
Yeah.
It really shows that in taxation, the details, the definitions, the classifications, they matter profoundly. It's not just what you earn, but how it's earned and what expenses genuinely relate to it.
So what's the big takeaway for you, the listener? It means you've got to move beyond just, plugging numbers into software.
Right.
It means asking those deeper questions. What kind of income is this, really? Is this business truly active? Are these expenses properly allocated?
Right.
Challenging assumptions.
That NIT is just one example, a powerful one, of how really understanding the tax code empowers you. It lets you ensure you pay what you owe, but absolutely no more. And maybe, just maybe, uncover savings you didn't realize were there.
Which leaves us with a thought. What other parts of your financial life, maybe investments, maybe business structure, maybe retirement planning, hold similar hidden complexities and opportunities just waiting for their own deep dive?